Hello, everyone, and welcome to the Business Income and How It Is Taxed webinar. We have Tanya Luken today from Luken CPA, and we have Paula Whittigan, who is going to inform me about the Small Business Development Center. So if you have any questions, would you please just put them into the Q&A, and I'll be able to read those out loud for Tanya to answer. And I'll be seeing you guys in the chat and answering those questions that you may have. So, Paula?
All right, welcome and good morning, everyone, to Business Income and How It Is Taxed. So let's get started. Before I turn it over to Tanya, I want to give a brief overview of the SBDC and the services we provide to small businesses. So just very quickly, for those not familiar with the SBDC, the Small Business Development Centers are actually a national network where you find us in every single state. And in Arizona, we have multiple locations across the state. We have about 10 SBDC centers. So no matter where you're coming to us today in Arizona, there is going to be an SBDC center close to where your business is that can help you. Here in Maricopa County, we have about 15 counselors. And what we offer really is no-fee counseling to our small businesses. So whether you're just starting out and have an idea and you're not quite sure where to go next, or maybe you've started and you're kind of struggling to get those sales, or maybe you're at that point where you're scaling up, or maybe an established business where you're just trying to sustain and you need some counseling, you could really benefit from counseling services. We have tools and resources to help you. We also have low or no cost training, such as the one we're in today. We cover many different areas for technical assistance. Of course, coming through COVID, we've been helping a lot of our clients with the COVID disaster funding, and we're still helping those clients navigate through those PPP loans, forgiveness, the new grants that are coming out, potentially more in the future. But many different areas, business planning, lender readiness, building resiliency in your business. There's a host of areas. Think of any business development area, and our team of counselors has the knowledge and expertise and resources to help you in your business. Again, some of those free resources that we offer if you're a client of the SBDC, we have Growth Wheel. That's a very comprehensive business development tool set that we use with our clients. We have free access to Live Plan and the business planning platform. For our clients, we have industry data. One is Profit Sense, which provides financial industry data, and then IBIS World Industry Reports, and then of course our SBDC Net organization for if we have need for specific marketing types of reports. So great resources available to you, as well as the no-fee counseling. And at the very end of this, once Tanya's done sharing her great information on business taxes, I'll share with you how you can request counseling from the SBDC and what that process looks like. So with that, welcome Tanya. Tanya's a regular speaker for the Maricopa SBDC, and happy to have her back again today to go through business taxes. And she comes, as you see on the screen, with a host of expertise and involvement in the community. So welcome Tanya, and I'm going to stop sharing and turn it over to you.
Thanks, Paula. All right, now it's my turn to figure out how to share, right? Good. Okay, so good morning, everyone. Today we're going to talk about your small business income and how it ultimately gets taxed. And then just a quick, there we go. Just a quick disclaimer. The purpose of this presentation is just kind of for educational purposes, and it's designed to enhance your knowledge of tax matters, and it's not intended to be specific advice. So make sure if you do have any specific questions, like I'm happy to answer whatever I can throughout the presentation, but just know that in the 2 hours that we're allowed today that we're talking, it isn't going to cover everything that's going on your income tax return. Okay, so the first thing I wanted to talk about today is the types of business entities. So in the US, we have basically 5 most common types of entities. There's a sole proprietor, a partnership, an SCorp, a C-Corp, and an LLC. The reason that I wanted to talk about these is because these types of entities will drive what income tax return you're going to file. So before we talk about the types of tax returns, just about the entities. So a sole proprietorship is basically one day I decided that I woke up and said, you know what, I'm going to start a dog grooming business today, right? I'm a sole proprietor. That's it. There's no, you don't have to form anything. You don't have to file anything. You don't have to, you know, you just do, and that's it. There's some certain best practices, which we'll talk about in a little bit, but the second type of entity is a partnership. So let's say that Paula and I decide to get together and form a dog grooming business. We are a partnership. And in that instance, absent an agreement otherwise, we would split the profits proportionally between the number of partners. So since there's two of us, we would each own 50%. The third one is an SCorp. And so this one, you have to file paperwork with here in Arizona, the Corporation Commission, to form your corporation. And then you have to tell the IRS that you're going to be taxed as an SCorp. And it's just a one-page form, name, address, tax ID number kind of thing. A C Corp, you also form with the Corporation Commission. Most people actually form C Corps in Delaware because there is no corporate tax rate in Delaware. But the reason that C Corps generally exist for really large organizations. So if you think about like the companies that are traded on NASDAQ or on the stock exchange, those are usually C Corps. And then LLCs, which are limited liability companies. They're the newest type of entity. They came around probably in the 70s or 80s. And LLCs allow a lot of flexibility. You have to form them with the Corporation Commission in Arizona, but once you form them, you're done. There's no more paperwork. So both types of corporations in Arizona require annual maintenance and a small fee with the Corporation Commission. Okay, so the tax forms by type. A sole proprietor files a Schedule C, which is attached to their regular 1040 form. So if you've ever earned income in the United States, you filed a regular old income tax return and you filed a 1040 return. And the Schedule C is just a couple pages that are just attached to the back. A partnership has to file a Form 1065, which is a separate income tax return. So the business files a 1065, but as individuals, we also have to file a 1040 for us, but the business also files one. Same with an S Corp and a C Corp. They file an 1120 form. It is a separate tax return, separate from your personal return, again. And then LLCs, and this is the reason the LLCs are so popular. One, because you don't have to file paperwork every year with the Corporation Commission. And two, because you can file a 1040 Schedule C or a 1065 or an 1120S or an 1120. So you have a ton of ways to do some tax planning to minimize your tax liabilities at the end of the year if you're an LLC. However, there's kind of a little bit of a pitfall with LLCs, and there's a default status. So I'm just going to read through this. A single member or only one person, so if you form an LLC and you're the only person, they default to filing a Schedule C or on a 1040 form. They can elect to be taxed as an S Corp or a C Corp. Multi-member LLCs, so 2 people, 8 people, 3 people, however many people, as long as there's more than one, will default to filing a partnership return or a 1065. They also can be elect to be taxed as an S Corp or a C Corp. Excuse me. Elections can be made before you file your first return or before February 15th of the current year for the prior tax year. So let's talk about what that means. So this election, you can make it, if you formed your LLC in 2021, you have until you file your tax return in 2022 to make this election, if you wanted to. You have also until February 15th of 2022 to make the election for 2022. But if you formed your LLC in 2020, during COVID times, if you formed during 2020, you had until February 15th of 2021 to make this election. But if you've already, so the time has passed to change the election status for the tax year 2021. but you can always change it for next year. Up until February 15th of that year, you can change it, okay? The reason that you would want to make the change is because there's different tax benefits, and we're going to talk about some of these, but there's self-employment tax that both Schedule C filers pay and partnerships 1065 filers pay, but SCorps have to take a payroll, which then creates payroll taxes. And we're going to talk about all those things, but there's reasons that you might want to do that, because you can kind of offset the payroll taxes with the unemployment taxes. Okay, so then I want to talk about pass-through entities. So only SCorps, so those ones that we were talking about that are traded on the stock exchange and usually from Delaware, they pay income tax on their 1120. So if you're a SCorp, you're going to take your revenue minus expenses, and then you pay an income tax percentage on whatever that number is, okay? Owners of a partnership and an SCorp receive a K-1 every year, and a K-1 is like a giant W-2. It basically says, here's the revenue of the business, here's all the expenses, I own X percentage, so let's say we own 50%. So then it's going to say on my K-1 what that 50% is, what the dollar value is, and that number goes on my 1040 form as a person. A K-1 is part of the business income tax return, both for 1065s, which is the partnership, and 1120Ss, which is the SCorps. All the information on the K-1 is put on the owner's personal 1040 form, and it's called pass-through income. So what happens is if you have, so my business, my accounting practice is an SCorp, okay? So let's say revenue minus expenses, let's say I have $100,000 of revenue and $30,000 of expenses. So I have $70,000 of net income from my business, okay? We're just gonna assume for this simple example, it's all taxable. What happens is my SCorp files a tax return that said there was $100,000 of revenue, $30,000 of expenses, there's $70,000 of taxable income. And then there's a K-1 that's attached to my 1120 form, 1120S, that says Tanya Luken is the sole 100% owner of Tanya Luken CPA PC, right? My SCorp. And then what happens is that K-1 goes over to my personal return, and a couple lines down on my 1040 form, it says income from K-1, and it would go $70,000 right there. So what happens, there's no tax on my business. It has to file a tax return though, and there is tax on my personal return starting at and the starting point is whatever my business income was that flowed through or passed through to my personal return. Okay, does that make sense? Clear as mud? I used to have a tax accountant or a tax teacher in college that would say that, clear as mud all the time. So, okay, so pass-through income is important. So the reason that it's important, there was a change in income tax law a couple years ago, and we're going to talk about that because of the qualified business income reduction. But first, okay, let me see this. Okay, so the question is, do we still have to take all 70,000 of income, or can we leave some in the company and W-2 ourselves as an SCorp? Raymond, I'm gonna hold on to that question for a minute. And then Genevieve asks, so pass-through is better than showing yourself as an employee and paying payroll tax. And I'm gonna table that one too. So don't let me forget to answer these, but I think things will become more clear. The basic answer to the first one, to Raymond's question, is that business income is always taxable regardless of how much money you take out of the company, okay? And then to Genevieve's question, it's not, if you're an employee and paying payroll taxes, that's one thing because you'll offset the self-employment tax, but not all business entities need to have W-2 owners. And if you do have payroll, and you shouldn't, if you're an owner and you're a W-2 employee, that you should not be a Schedule C filer or an 11 or a 1065 filer partnership. So we'll talk about both of those in a minute. Okay, so first, what is business income? So generically, maybe, business income is the inflows, the revenue collected from your clients, your customers, whoever, minus the outflows, the expenses. So your outflows for payroll, your outflows for rent, whatever it might be. Generally, cash taken by an owner is not a business expense. So think about, I'm just going to assume most of you are using QuickBooks. So if you think about your balance sheet and your profit and loss, when you look at your profit and loss, it starts with revenue and then it shows all your expenses and then it gives you a net income number, right? But what's not on there is shareholder distributions, owner draws, owner distribution and pay. Those things, if you remember from looking at your financial statements in QuickBooks, those are equity accounts and they're on the balance sheet. So you pay income tax, or your starting point for income tax is revenue minus expenses. So it's the number on your profit and loss, okay? Generally, there are some limitations. So a couple of ones that are worth noting: meals generally are deductible at 50%. Some meals are excluded entirely. Entertainment is excluded. Membership dues are excluded as well. And travel is limited to business use. There's special rules for the business use of a personal vehicle. No commuting miles are allowed. And there's home office deductions, and then the QBI. So let's talk about each one of these. So generally, meals are deductible only at 50%. So if you take a client or a customer or an employee out to lunch, you spend $50, all $50 will go as a business expense on your financial statements, but only $25 will be deductible on your tax return, okay? Some meals are excluded in their entirety. I'm just gonna spare you the boring reasons about why some of them are excluded, but generally if it's for a business purpose, it's at 50%. Entertainment is also excluded at 100%. However, remember that these things are limitations on what's allowed as a tax deduction, not what's allowed as a business expense. So you might be in an industry that is expected to wine and dine and entertain your clients, right? So in my mind, like I'm thinking, let's say that you have a sports marketing company, right? So you might be expected to take ball players out to big fancy events, or like the Elton John concert next year, or buy them big fancy meals or things like that. So when you do those expenses, if they're the entertainment, like if you went and bought Elton John tickets for one of your clients, for your sports marketing clients, it's excluded. Is it still a business expense and something that you need to budget for and manage and pay for and all of that? Yes, but it's not going to end up on your tax return, is what I'm saying. Travel is limited to the business use. So for example, let's say that the American Institute of Certified Public Accountants, we're a really rambunctious bunch. Let's say that we decide to have our annual convention in Hawaii, okay? So the convention is going to start on Monday, and it's going to go from Monday to Wednesday. So I decide that I'm going to go, but I decide that I'm going to go on Friday, and I'm going to stay Friday, Saturday, and Sunday in Hawaii, and then go to the conference Monday, Tuesday, Wednesday. So I'm going to be gone for 6 days, but I'm only at the conference for 3 of those days. So I only get to deduct 50% of my expenses for that trip, okay? The reason is because the limit is only business use. So when I go to buy my plane ticket, for example, or when I go to pay for my hotel, I'm not going to pay for 50% of it with my business card and 50% of it with my personal card. I'm just going to have to add it back in at the end of the year, okay? Okay, so commuting miles. So let's say that my office is in Tempe and I live in Chandler. So I drive from my home to my office. Those are commuting miles. Let's say then I leave my office and I drive down to the SBDC office in Phoenix. So if those would be business miles to me, So I could deduct the mileage or the expenses for that trip from my office to the SBDC office, but not the portion from my home to my office. And then home office deductions are allowed. There's some very specific rules. So if you feel like you qualify for a home office deduction, then you should take one. I'm just going to warn you that it's very auditable. The IRS really loves to look at home office deductions. So if you're going to try to push yourself into a gray area on your tax return, know that this one is a very dark gray. Okay. All right. Then questions, are we good?
Tanya, we have a question from Melissa. She had asked a while ago, what about an LLC that's only a married couple that files taxes jointly? That was for our previous slide, I believe.
Okay, so an LLC, there's a weird little rule. So if a husband and wife own an LLC together and they file a joint tax return, a joint 1040 return, then they would file a Schedule C instead of filing a partnership return. So there's a weird rule because the husband and wife are in the LLC together, and because the husband and wife are filing a joint tax return, the IRS doesn't make them file a 1065 partnership return and then put it on their personal return. They can just file a Schedule C on their personal return. Does that, let me know if that doesn't answer that question. And it's a weird rule, and only if you're married filing jointly. Okay, so good.
So she asked, so it's basically like one person?
Yes, it's treated like one person because it's the part of the paperwork reduction, whatever thing that the IRS does. So yes, so it's treated like it's because you're filing the same personal return, you get to file the same business return, just as the Schedule C. So,
all right, thank you.
You're welcome. Okay, so let's talk about the qualified business income reduction. So, or QBI. So QBI, every time I think of this, I think of that old video game QBIC, which makes me laugh. So I used to always jump off the back, you know, I don't know if you remember that. I'm probably just dating myself, but so QBI, there was a job, I always say it wrong, but there was a Tax Cut and Job Act that was passed about 4 or 5 years ago, and the SCorps income tax rate was lowered to 21%. Pass-through income, remember we were talking about pass-through entities, Schedule Cs, 1065 partnerships, 1120S for sole proprietors. They could be taxed as high as 39.6% for single people. So in the United States, our personal income tax returns are graduated. So you think of it like a set of stairs where it just kind of goes up. And so every increment that it goes up is how our income is taxed. So our very last earned dollar, if you go along the bottom of the stairs, is taxed at the highest dollar amount. But the first dollar we earned is taxed at a really low dollar amount. And it doesn't go up diagonally in a nice smooth line. It literally jumps like a set of stairs. The highest rate a person could pay, a single person can pay in the United States is 39.6%. It's the same for married people, but there's some weird different rules, but basically it's 40%. So when they passed this law and said, hey, if you're a C Corp, you only have to pay 21% income. But remember I told you that I'm an S Corp? I was like, wait a minute, I still have to pay 39.6%? Like, how is it fair that I get to pay an extra 20% income tax? Like, that's not cool, right? So what they did is they came up with the QBI. So the QBI, this qualified business income reduction, it's allowed for partnerships, sole proprietors, and S Corps. You notice that C Corps are not on this list, right? It's only those pass-through entities that we talked about. So partnerships, sole proprietors, S Corps. It's disallowed for specific service businesses with high taxable income, and it's phased out on W-2 wages. And phased out means it's reduced incrementally until it reaches zero. So let's talk about these things. The specified service businesses, what businesses are in there, we'll talk about on the next slide. The phased out on W-2 wages it means basically like as your income grows, so your QBI deduction is 20%, okay? And as your income grows, once it hits a certain threshold, then your QBI starts backing down. And so what happens is eventually they move in opposite directions. So as your W-2 income goes up, your QBI percentage goes down. At a certain threshold, it will zero out entirely and you won't get a QBI deduction. We'll talk about what those thresholds are. So here are the specified trader businesses. And this one, remember, all businesses that are partnerships, sole proprietors, and corporations qualify, but it starts to get disallowed and phased out for these businesses, okay? So if you're in healthcare, if you're a lawyer, you're an accountant, which PS, like where was my lobbying group that day when they were passing this bill? Anyways, actuarial sciences, performing arts, consulting, athletics, financial services, brokerage services, or any trader business where the principal asset of such trader business is the reputation or skill or one or more of its employees or owners, or performance of services that consist of investing and investment management, trading, or dealing with securities, partnership interests, or commodities. So if you're in one of these industries, that phase out is going to apply to you, okay? Here's the general rule. Do you eat hot dogs in your house? Do you eat steak at your house? Or do you eat caviar? If you're eating hot dogs, you're gonna qualify for the QBI. If you're eating steak, you're probably gonna qualify for the QBI. And if you're eating caviar all the time, you're not gonna qualify for the QBI. So QBI is a 20% deduction for the pass-through entities. And when I say this is oversimplified, there's some rules about like, well, I'll just spare you. It's kind of a complicated hot mess because, you know, we let Congress write our tax law, but the reason that it's the 20%, it's roughly 20%. There are some add backs and some weird things about interest, but don't worry about it. Most of us are just going to take the 20% deduction. So the 2020 phase outs, married filing jointly is $326,600 up to $426,200. All other filers had a household, married filing separately and single starts at $163,300 and goes to $213,300. So I'm an SCorp, I'm single. So let's say my business income, my revenue minus expenses, my profit and loss from my SCorp was $150,000. I had $200,000 of income, $50,000 of business expense. So I have $150,000 left over, okay? Because I'm single, that $150,000 is less than the $163,300. So what's gonna happen is then my $150,000, I'm only gonna pay income tax on 80% of that, all right? I get a 20% deduction right off the top because I'm under the $163,000. So I don't know if you know this, but your income tax status is determined by how you are, you know, if you're married or not married on the last day of the year. So let's say that I'm about to leave town and go to Nebraska to hang out with my grandma. She's 97 and I haven't seen her since COVID. So I'm going to be in Nebraska for 2 months hanging out with my grandma. Let's say I happen to meet a super rich and extremely handsome cowboy while I'm in Nebraska, and he makes $50,000 or $500,000 a year, okay? We decide to get married. We run off to Vegas and get married, and it comes December 31st, and we're still married, and my business income is still $150,000, but now he has $500,000 of his cowboy income. So now all of a sudden, our married filing joint return has $650,000 worth of income. So because we're married, this phase out amount is $426,000. We don't get any QBI deduction then. It's gone because we're above the top threshold of $426,000. So as you reach these lower thresholds, the 326 and the 163, that's when your reduction will start going down. That's when the 20% will start going down. And then once you reach the 213 or the 426, it'll be 0 altogether. Okay. So these phase out amounts change a little bit every year. So these are just happen to be the 2020 amounts. I should probably update them for 2021, but they haven't changed significantly. At most, probably maybe $5,000 one way or the other. Okay, so that's QBI. So it's kind of nice because it means because of the algebra, most of us with flow through entities are now a lot closer to that 21% tax that the SCorps get. All right, clear as mud. Any questions?
There's one question by Indira. How it is taxed if payment is done by client to a person independent contractor before LLC is created by the business owner?
So I think I got all that. So if you're an independent contractor that hasn't done anything to create an LLC, you're a Schedule C filer. You're just a sole proprietorship, not just a, but you are a sole proprietorship, and you are considered a Schedule C. You'll file your business income from your independent contractor relationship on a Schedule C form. So if they don't reimburse you for, like, let's say you need a cell phone, or you have to drive somewhere to like do the work, or you have to pay for your own laptop repair, or you have to pay for your own email account, all of those things would be business expenses to you in that independent contractor relationship. So.
All right, thank you.
You're welcome. Okay, let's talk about self-employment tax. So I'm going to tell you a funny story. When I was a kid, I had my first job at a place. I won't tell you the name because then you might be able to hack all my secret codes. But I had a job in an amusement park, and I thought I was the bomb, and I had a fairly decent GPA, so they gave me 10 cents over minimum wage. So I was making $4.15 an hour, and I thought I was the bomb. Like, I was so excited. I was like, man, I'm going to be rich at the end of this. And I came home with I got my first paycheck, and I tore open the envelope, and I was like, what is a FICA? Like, I was so irritated because somebody had like gone into my paycheck and taken almost 10% of it away. Well, I later found out that it's Medicare and Social Security, or FICA. So your employer, when you receive a paycheck, Medicare and Social Security are deducted from your paycheck as FICA. Your employer then matches the Medicare and Social Security amount of your check. When you're self-employed, no employer is matching your Medicare and Social Security because you're not an employee. You pay the employer match portion of Medicare and Social Security on your personal income tax return. It is 7.65% of your taxable business income. This is in addition to your regular income tax. So let's break all this down. So there's some specific rules about SCorps having to take a reasonable paycheck, and we're going to talk about that in a minute. So setting aside SCorps for a moment, if you are self-employed, okay, and you are a Schedule C filer, for example, or you're a partnership, or you're an SCorp, there is a chance that some of the business income that you have will be subject to Medicare and Social Security if you're not on payroll. So SCorps will have to be on payroll, so we're going to back those out again. And then, but partners in a partnership that file a 1065, so me and Paula, we start our dog grooming business, we each make $50,000 from the business, we have to pay self-employment tax on our $50,000 on whatever our K1 income is, all right? If I'm a sole proprietor and revenue minus expenses for my dog grooming business is $50,000, I pay self-employment tax on my Schedule C, well, on a Schedule SE, on my personal tax return of 7.65%. Because I'm not an employee getting a W-2 paycheck, W-2 wages, there is no employer that's matching my Medicare and Social Security, but we all have to pay into the system. So that's how the IRS has you pay into the system. It's on your personal tax return. So if I do find my handsome rich cowboy when I get to Nebraska and he makes $500,000 and I have my $150,000 of income, guess what? if I were a partnership, if I were a sole proprietor, I would pay self-employment tax on the $150,000, plus we would be in the highest tax bracket and we would have to pay 40% income tax as well, okay? On our last dollar, not on all the dollars, but on the last dollar. Okay, so that felt kind of confusing. How do you guys feel about that?
There is one question.
Okay.
So it's a gig worker question. Which business structure is better tax-wise for a small business owner that earns less than $10,000 in revenue per year and has other income with a full-time job, a sole proprietor, or LLC?
So if the tax structure would be exactly the same for a sole proprietor or an LLC, as long as there was only one member in the LLC. And I would say the reason that you would want to form an LLC in that instance, even if you're only making $10,000 a year, would be to protect your personal assets. So people form LLCs or corporations to protect their personal assets from outsiders. Like if I were, let's say that I messed up something really bad on a client's financial statements and the client went bankrupt and the bank came to me and said like, hey, you said they were going to be able to pay back the loan and they didn't. Well, the bank can sue me as a CPA. So in that instance, I have a corporation to say like, you can sue my corporation, but you can't take my house for me. Okay. We'll talk best practices at the end, but I would say in that instance, you would want to consider forming an LLC to protect your personal assets from any outside influence that should go wrong with the business, okay? And then the tax treatment for a single member LLC is still a Schedule C sole proprietor form, so they're the same. But if you do decide to like advance if you decide to grow that business and all of a sudden you're making $100,000 a year, having an LLC gives you a great way to change how you want to be taxed and do some tax planning in the future. So, okay, hopefully that answered that in a really long roundabout way. So,
yeah, she said, thank you.
Perfect. Okay, so since business income usually passes through the owner, it all gets taxed at the owner's ordinary income tax rates. So remember that when I find my handsome rich cowboy, we're just going to end up in that super high tax bracket, right? So what I wanted to, this is a 30,000 foot summary and we're going to go through this, but I wanted to put together a chart for you guys about who pays the taxes, where does it pay it? How do I file do I have to file a return? Do I have to pay self-employment tax? Can I file the QBI? Because that was a lot of topics that we covered. So basically, these are the different types of entities here, right? So there's a sole proprietor, an SCorp, and a C-Corp. And then there's an LLC that is a Schedule C filer, a partnership filer, an SCorp filer, or a C-Corp filer. So if you notice, does the business pay the tax? It's only for the C-Corps and the LLCs that file as a C-Corp. They pay your business income tax, okay, at the corporate level. Does the owner pay the tax on their 1040 form? Yes, for a sole proprietor. Yes, for an SCorp. Yes, for a Schedule C filer, that's an LLC. And yes, for partnership LLC filers, and yes, for SCorp partnership. The reason I say oversimplified about the two C-Corps is I don't know if you've ever heard that phrase, the double taxation of income, but that's how C-Corp income gets taxed twice. So once because it pays tax at the corporate level, the 21% that we talked about, but the only way to get money, actual cash out of a C-Corp is to pay it in wages, which we all know if you get a wage from a company, it's W-2 income and it goes on your personal tax return, right? So then it's taxed at the corporate level and then taxed again on your business return. Or you can get dividends from a C-Corp, just like you would if you invested in the stock market and they paid you a dividend. And then, as you may know, dividends also are reported as investment income on our personal tax returns. So that's my oversimplified, but technically for our purposes, the ones with check marks here is where the tax is paid. And then do we have to file a separate business tax return outside of our regular 1040 return? And you do if you file as a C Corp or file as an S Corp or file as a partnership. The reason I didn't check for sole proprietors is because those sole proprietors file a couple of pages with their regular 1040 return, okay? Self-employment tax is, remember, the 7.65% for Medicare and Social Security that no one's paying for us. And that's paid for sole proprietors. That's paid for schedule LLCs. Oh my gosh, my check mark's in the wrong place. I'll fix that in a minute. They're paid for partnership filers, and they're paid for S-Corps, kind of pay self-employment tax, which we're going to talk about on the next slide. So hold that thought for a minute. And then where are they eligible for QBI? So sole proprietors are eligible for QBI, S-Corps are eligible for QBI, and LLCs are eligible for QBI. All right. So in about S-Corps. So S-Corps that generate positive taxable income must take reasonable compensation from their business as W-2 wages. S-Corp owners are employees of their own business. Schedule C filers should never be an employee and should never receive a paycheck. They get money as an owner draw. This is not a business expense. Partners in a partnership should never be employees and should never receive paychecks. They get money as a guaranteed payment instead, and guaranteed payments are business expenses. So let's talk about each one of these. So the question that we had earlier about S-Corp income and W-2s for yourself. So the IRS requires that an owner S-Corp has to take reasonable compensation, right? So, and literally the statute says reasonable compensation. They don't define if you're in this industry, this is what's reasonable. If you're in that industry, this is reasonable. They just say reasonable compensation. So you would have to think, what would I have to pay someone to do what I do every day, right? And most of the time as business owners, we have fairly decent days, but sometimes we can have some really challenging times. And sometimes like we wouldn't be able to pay someone enough to do what we do, right? So just try to think in your mind what feels reasonable. You can look, you know, let's say that you are a carpenter and you have a business, you own an S-Corp and you make cabinetries or cabinets and do kitchen remodels, okay? So you could, in theory, go look to see what other carpenters are making in the area. Like you could go onto Monster, I think, if they still have Monster, but Monster used to have like a salary guide where you could see the ranges of salaries. So you could do that, but a lot of times the income that we generate from our business isn't as much as what those salaries would be, in which case then you would have to reduce it to be what feels reasonable, okay? There is no guide here. There's no magic answer. There's no way to look this up. So you just kind of have to go with what feels reasonable and then document why that felt reasonable. Just send yourself an email. This is what my salary is going to be this year, and it's because of this, all right? So one other quick note about that. So I'll tell you what I do personally. So personally for me, in February, I hired 2 new full-time employees. And as you may know, when you hire an employee, it takes a couple months for them to figure out what they're supposed to be doing, and then for you to make some money off of them. So I stopped taking a paycheck in February, and then I went back and I picked it back up at the start of, well, about mid-May or so, when they started kind of earning money and cash flow was better, which I'm allowed to do. Like I can stop and start my payroll as an owner. You can't do that for an employee, okay? So what I'll do this year is I'll make sure as the year progresses and as we continue to grow the business that I'm looking at my revenue minus expenses and seeing what that number is and making sure that I'm taking a reasonable percentage of those profits from the business as W-2 wages for me. Okay. So let's talk about sole proprietors and Schedule C filers for a second. So they should never be employees and should never receive a paycheck, because all of the W-2 income, all of the taxable income from a Schedule C is subject to self-employment tax. All of it, 100% of it. So you have revenue, you have expenses, whatever's left over, if it's a positive number, is subject to self-employment tax. If you were to take a paycheck and you file a Schedule C, whether you're a sole proprietor or a single member LLC, if you file a Schedule C return, you're going to pay Medicare and Social Security out of the paycheck. You're going to match it as an employer, and then you get to pay it again on your tax return. So you're paying it 4 times, and you don't want to do that. So if you are a Schedule C filer and you have had payroll this year, actual W-2 wages with withholding, Medicare and Social Security, you need to try to get those reversed and get your tax payments back. Okay. When an owner takes money out of a company for a Schedule C, it's just a draw, or owner payments or something QuickBooks called it, but it's just a draw. It's not a business expense. Partners in a partnership should also never be employees, and they should never receive regular old paychecks with withholding. They get a guarantee payment instead. And guarantee payments are business expenses. So let's say we're back to Paula and I's dog grooming example, okay? We earn $200,000 in revenue, and we have $50,000 in expenses. So before our guarantee payments, we have $150,000 of taxable income, okay? Let's say that I'm the silent partner because I've married my rich, handsome cowboy, and I'm just in it to as an investment and to help my friend Paula. So let's say Paula works in the company all the time doing the dog grooming, right? So she should get paid for her time to work as an employee, right? To work in the company. So let's say Paula and I agree that she's going to make $50,000 a year. So follow my example. We have $200,000 of revenue, $50,000 worth of shampoo and whatever expenses for $150,000 of gross profit. And then Paula gets a guarantee payment of $50,000. So that guarantee payment comes off the number, and then we have $100,000 of taxable income left over, okay? Because we're 50-50 partners, I get $50,000 on my K1, Paula gets $50,000 on her K1, but because she also got the guarantee payment, that gets added to her K1 as well. So in my example, I pay income tax on my 1040 form at $50,000, and Paula pays hers at $100,000. So it's still the same $150,000, but Paula gets more of it because she got that guarantee payment. Okay, clear as mud?
Mark Jones asked, what about C-Corp payroll?
So C-Corps are, you get a W-2 wage. They have to be, if you work for a C-Corp, you would have to be on payroll. And there is no reasonable compensation test for C-Corps, mostly because C-Corps aren't they're owned and managed more by a board than they are by a person. But you would have your regular payroll and payroll taxes that would be matched by the company, and then those W-2 wages would get reported on your personal tax return. There is no reasonable compensation requirement for C-Corps. So.
All right. And then we have a follow-up question about will the income after creating LLC be taxed the same way? So this was a follow-up question to the payment being done by a client to a person.
Yeah, so wait, repeat that again one more time.
Okay, so the follow-up question, will the income after creating LLC be taxed the same way?
Yes, provided you don't choose to be taxed as an SCorp. Yes. So if you're a single member LLC you get taxed outside an election to be taxed otherwise. So if you don't do anything, you'll be taxed as a sole proprietor with the Schedule C form. And if you do nothing and you are an independent contractor to someone and receive a 1099, that means that you're a sole proprietor and you file the Schedule C as well. So,
All right, those are the 2 questions we had.
okay,
Thank you, Tanya.
you're welcome. All right, so let's talk about tax payments. So this is how you make tax payments. You go to this great website called Eftps and you enroll as an individual. So unless you're a SCorps, and then you're already enrolled because the IRS is auto-enrolling people. This website is amazing to make your tax payments. So you can go here and enroll as an individual. They'll mail you something and it takes a hot minute, whatever else, but you can go in and tell it, I want to make my payroll, or I want to make my estimated payments today for my personal tax return. And you can do it here in about 3 clicks, and it's super easy, super secure, and like, I love it. No more mailing checks and tiny coupons to the IRS, because I don't know if you know this, but there are giant trailers sitting outside most IRS facilities filled with backlogs of mail. If you use Eftps, your payment's going to get there. It's going to get processed timely because it's all done automatically. Secondly, you can enroll in AZ Taxes as a human being or an individual as well, and you can make a payment. So you can just click on this make a payment. There's no registering for AZ Taxes. So you can just click make a payment, make whatever estimated payment you want for whatever tax period that you want, and it goes super lickety-split as well. So then this is some information. I included this. I'll send these slides to Esmeralda, and then she can, I'm gonna make that correction on the 30,000 foot one, but I'm gonna send these slides to Esmeralda and she can send them on to you guys. But here's the FAQs for the QBI. So you'll be able to go here and find out all the things you never wanted to know about the QBI. This is the website for Eftps to make those payroll taxes, and then aztaxes.gov. And then, because usually someone asks me, is the Department of Revenue holds classes on sales tax or TPT tax here in Arizona. So you can go here and find a sales tax class near you. So here's my contact information if you have questions. But know that I'm traveling to find my super rich, handsome cowboy husband. So in the next couple of days, so I might be slow to respond, but go ahead and send me an email if you have any questions. And then if you guys, I'll give you a minute to make a note, but if you guys will indulge me, I'm going to show you one other thing today about kind of those differences about why you might want to choose to be taxed differently. So like, for example, if you're an LLC, a single member LLC that files as a Schedule C, why you might choose to be taxed as an SCorp. Okay. All right. So give me just a second and I will get this open. And then if you have any other questions, sorry, my other monitor's over here. So if you have any questions, just put them in the chat or let us know. Almost. Okay. Got it. Oh, you guys, I'm so sorry. They're about to deliver something to my house and my dog is gonna get really angry and yell at this person to get off of my lawn. So as soon as she starts barking, I'm just gonna mute myself for a minute and then we'll go on, okay? So maybe one of you ladies can talk some more about the SBDC. Okay, so this is an example that I had done previously, and what we're going to do with this example is compare what a sole proprietor would pay, what an SCorp would pay, or what a SCorp would pay. So we're just going to assume that the taxpayer is single and that their business is the only source of income. Okay, these are huge assumptions, because if you like we were talking about, like if I do find my rich, handsome cowboy and I do marry him, then there's a chance that I'm going to have to spend like these rules that we're about to talk about aren't going to apply because he has $500,000 of taxable income. Okay. Boy, she's really eyeing him. Okay. So let's pretend that my business has $1,000 of revenue, and
That's okay, Tanya. This is Paula. I love one thing about the virtual world is we all get to know each other's pets, I think, on a regular basis. So no worries on that. Yeah, while we're waiting for Tanya and her pooch to finish greeting the delivery guy, I'll talk a little bit about SBDC counseling, and I'll be sharing a slide, but it's really easy to request counseling. This financial review is one area where we can help our clients, is as we're kind of sitting down and we're looking at their financials, we can kind of identify and have some conversations with you about, do things look like they're set up correctly in your P&L and your balance sheet? And just kind of and talk through the P&L and the balance sheet, how to use those in your business, make sure the accounts are set up right. And if you need some additional assistance, we're not accountants, but we can refer you to some of those resources like Tanya, who can really take a deep dive with you and help you kind of work through some of these questions about how you're the legal entity and how you're set up, and maybe make some corrections and really take you through that process of how you can kind of keep those financials up to date, make sure you have accurate records, make sure you're staying on the right side of the IRS. I was a business owner myself, and I wanted to make sure I followed the rules. So I never wanted to get that, that letter from the IRS saying, hey, you're not reporting correctly. So it's important as a small business owner that you have those bookkeepers and those accountants as a resource, even if it is just, once or twice a year, to make sure that those finances and taxes and everything is staying on track so that you can focus on your customers and generating revenue rather than trying to fix issues with the finances and taxes.
Thank you, Paula.
Sure.
Thank you, everybody, for indulging me too. So I just want to tell you that I am safe from the delivery person. I've been protected. So, okay. So in our assumptions here, so let's say our business had $1,000 of revenue. We paid some rent, some office supplies, some utilities, some telephone expenses, insurance, and we bought some meals. And we have net income of $867. So this right here would be basically our profit and loss for the period, for the year, let's just say. So, okay, sorry, didn't want to advance. So what we're going to do is we're going to carry that 867 forward here. And I'm making some real big assumptions here, because if you remember, this 867 included $6 in meals, but we don't know whether these meals were 100% deductible or 50% deductible in my example. So we spent $6, and we're just going to assume that they were all deductible. So our net income is $867. Then who has to take reasonable compensation? SCorps do. So our reasonable compensation for the owner is $560. Okay, so they're going to get a W-2 that says $560. But because it's payroll, and if you haven't come to the payroll class, like I think we're doing that one in October, but if you have employees, you're responsible for matching their Medicare and Social Security, right? The self-employment tax that we talked about. So because employers have to match Medicare and Social Security, that's the payroll tax expense, basically. So payroll tax expense on $560 is roughly $67. You also have to pay unemployment as an S-Corp, okay? But the nice thing is that during COVID, for example, if I had to lay myself off from my firm, I, as a person, could go file for unemployment from the state because I paid into it as an employer. Okay, so then you'll notice that there's no reasonable compensation or payroll taxes for sole proprietors or for C-Corps, okay? The 20% reduction, the QBI reduction we talked about, it applies for sole proprietors, but why is it different for an S-Corp? And the reason that it's different is because This $560 and this $67, those are business expenses. So now instead of having $867 worth of business income, it's been reduced to 100 and something, okay? So 192 actually. So that's the reason that the amount is lower, is because the business expense net income is no longer 867. It was 867 minus 560 minus 67. And then a dividend expense. So SCorps get to deduct anything they pay for dividends. So let's just assume our SCorp paid $500 in dividends. Notice that our SCorps and sole proprietors don't pay dividends. So our estimated business taxable income for our sole proprietors have net income 867. They only take the QBI reduction and they have $694 of taxable income. Okay. Our SCorp started with 867. They took $560 of payroll expense, $67 of payroll tax expense. They're going to get a QBI reduction of $48. So they will have $192 of taxable income. SCorps, we had $867 of net income. We paid out a $500 dividend. We have $367 of taxable income, okay? Let's assume that we're in that 28% tax bracket. So most of us Americans are in this tax bracket. So the tax at 28%, $194, $211, $140. Who's paying self-employment tax? Only the sole proprietor at $53, right? Who's paying the business income tax? Only the SCorp at $182. So then if you look at how much they're all paying in taxes, in this example, the sole proprietor pays the least, right? Because they're paying $247. And you see here, like this math doesn't quite add up. And it's because of this $67 in payroll tax expense. So part of this is deducted from your paycheck and then you match it as an employer. So I counted the FICA portion that comes out as an employee here. And then here, people pay income tax at the ordinary income tax rate on dividends. And there's the business income tax as well at 21%. So the SCorp pays the most in this example. So this is kind of just when we talk about like what type of entity is best and, you know, should I make an election to be taxed as an SCorp or should I stay a sole proprietor? You know, should I, you know, what should I do? Basically, CPAs can help you with this math. But if you're just starting out, do the thing that feels right to you and that makes sense to you. So for example, the person that was asking the questions about being an independent contractor. So if you're an independent contractor, and there's been a trend recently too, like with COVID, about more people wanting to be contractors and working for multiple companies instead of working just for one company. So if you decide to do something like that for you and you and yours, then you can be an independent contractor. And the easiest way to do it is to be just a sole proprietor and file a Schedule C and pay your self-employment tax, right? The reason that you would do things, that you would make a change to be taxed as an SCorp is there comes a point where the amount, like remember here, we're paying $67 of payroll taxes. There's a point where the amount of payroll taxes you would pay doesn't match and is less than what you would pay in self-employment tax. So for example, this self-employment tax number, it's going to continue to grow as the taxable income from our sole proprietor goes up. So let's say that this number was $10,000, right? Then all of a sudden, this is going to be $800 worth of self-employment tax. But if we could have paid ourselves $5,000 in payroll and saved 8% on that $5,000, then that might be less than the $800 we would have had to pay as a sole proprietor. So there's some wicked algebra that happens here, basically. So you want to have, like, and CPAs and tax preparers can help you do this math to figure out what's best based on how you file your return. Because again, the options that are available to you are going to depend on whatever else happens on your return. Are you head of household? Are you married filing jointly, married filing separately? Do you have a lot of outside investment income? Do you have a lot of rental income? Do you have other businesses that generate losses? All of those things factor into account. Okay, questions?
Yes, we have 3 questions. Okay, so the first one is, I'm the owner of an LLC treated as an SCorp. I pay payroll taxes monthly. When should I pay the income tax? Should I pay them when I file my 1040 at the end of the year? Or should I pay an estimate quarterly, then the rest when I file a 1040?
This is when your estimated payments are due. So a couple of things that you can do as an SCorp. So you can make estimated payments during the year. People are required to make estimated payments if their tax is going to be more than $1,000, which most of us it will be more than $1,000. These are the payment due dates. They're due April 15th, June 15th, September 15th, and January 15th of the following year. So you'll notice that 2 of them are on the quarter, the 15th after, and like the first payment and the 4th payment are 15 days after the end of the quarter, and the other 2 are 15 days before the quarter ends, right? Again, like we like Congress makes tax law, so it's very confusing. But when you make, you have a couple options available to you. So one, as an SCorp owner that's on payroll, you can increase your withholding on your paycheck, and you can get a higher amount. Sorry, the postman just pulled up, and my dog hates the mailman. Oh, good, they're going to the neighbors. Okay, so you can increase your withholding. You change your W-4 like an employee, or you elect to have an extra $200 deducted from your paycheck, and then you can make those more incremental payments throughout the year, for example, instead of making 4 quarterly payments. So you can kind of spread the money out. You also can pay taxes more often than these dates if you want. You can use Eftps, and every time someone pays you, you can give 5% to the IRS if you wanted. So whatever works best for you. The IRS is not a savings program though, so they're not going to give you any kind of decent interest. So there's some options available to you. You're required to pay in 100% of what you owed last year, or 90% of what you're going to owe this year, to avoid underpayment penalties. And underpayment penalties are basically just like, it's like insult to injury, but they're not extraordinary. So the underpayment penalty on like $5,000 of tax would probably be like, I don't know, $150. So, but at the same time, when you're faced with a $5,000 tax bill and then you owe another $150, then you're just like, really, come on. So like that's more of how it goes. So make your estimated payments. Your tax preparers can help you, or most tax softwares will calculate those amounts for you. So, but if you are an SCorp and you have withholding, that is an option. So let's say your estimated payments are $5,000 every quarter, and you have W-2 withholding of $4,000, you only have to pay in another $1,000. So.
All right, so we have another one. As a general contractor with an LLC, is there any other type of registration or permits that are required to complete in order to work for commercial, residential, or federal customers?
So for contractors, I think most are required to be licensed with the registrar of contractors. And I'm not familiar with that, but I would just call them up and talk to them about it. Most government agencies are super nice. If you say, hey, I'm thinking about doing this, can you tell me what I should know? Or they'll have classes about how to do it. And then always the SBDC is an excellent resource for those kind of pitfalls that people can fall into. So there's nothing else that I can think of for contractors. The one thing I would warn you about though, and I'm gonna warn all of you, is that the IRS is starting to look at W-9s and 1099s. So if you hire someone to do work for you in your business, so let's say I hire a marketing consultant to help me rebrand my website or something. If I do that, that person is likely to get a 1099 from me. So the IRS is cracking down on 1099s. So make sure that you have all those documents in order to file your 1099s at the end of the year. And come back in October and we'll talk about that one like in detail.
Okay, so I think I missed this part. Do I still tax as a single member LLC or LLC partnership if my husband is also a member in my LLC?
No, husbands and wives that file a joint tax, well, maybe husbands and wives that file a joint tax return that also are like two people, two members in an LLC will file a Schedule C. If for some reason you decide to file separately, so you're married filing separately, then you would file a partnership return. But until then, you would file a Schedule C because you're husband and wife and you own the same LLC and you own the same 1040 tax return. It's a weird rule for two-member LLCs if the members are husband and wife. So.
Okay, thank you.
Well,
So we have another one. Is business income tax on net income or taxable income after dividends deducted? The question is for a C Corp.
So if you are a C Corp, it is after taxable income. Dividends are an expense to a C Corp, so tax would be based on earnings after dividends.
Okay, thank you. Those are all the questions we have for now.
Perfect.
All
Okay.
right.
One other thing I just wanted to make sure that you guys are aware of. So Paula was talking about like not getting notices from the IRS. So there's a whole plethora of notices that are going around now because of those giant semis full of mail that the IRS has not processed. So one, be patient, because if you do call and happen to get through, like remember that everyone is in the same boat, you know, and the IRS is aware that it's a problem. And so they have stopped sending notices until they can process the mail. But once they process the mail, there's going to be a whole slew of notices that go around. So just if you get something from some regulatory agency, open it and deal with it because it doesn't go away and only gets worse. Okay. The other thing I wanted to talk to you about is that the reason that you form these business entities, so the reason that you, for example, that you form an LLC or you form a corporation is to protect your personal assets. And the reasons that you want to protect your personal assets is to make sure that if something happens in your business, you're still okay at home. You know, it's the whole my own oxygen mask first kind of thing. But if you commingle money, so if you pay for all of your business expenses out of your personal account and your personal expenses out of your business account, and all the money is all convoluted and mixed up everywhere, they're not going to see that as two separate things. Here's my personal stuff, here's my business stuff. So make sure that you keep your business expenses in your business account, checking account, and your personal expenses in your personal account. What you do is if you're an S-Corp owner, you're going to take a paycheck and you'll transfer that. You'll have direct deposit or you'll transfer that money from one bank account to the other. However you do it, you're allowed to take distributions as an S-Corp. If you're a partnership and you get guaranteed payments, you're going to write a check from the business and deposit in your personal account or transfer the money or do a bill pay or whatever you want to do. But take the money out of your business, put it in your personal account, then pay your personal bills, okay? Because that's something that you can, like, doing that will help you be a better business owner and not make a big hot mess later, basically. So, oh yeah. Let me see if it's in this. Hold on, let me open another PowerPoint and then I'll talk to you about the PPP. Oops. I do so many of these. Okay. Okay, so COVID programs, let me make this a little bigger. There was a couple things. So there was the 2 paycheck protection loans. So the first round in April or May or into August of 2020. And then the second round was started in February of 2022. So for federal income tax purposes, they are not taxable income when they are forgiven, and all of your expenses are allowed to be deductible. So basically, if you got a PPP loan in 2020 or 2021, it's not going to impact your income taxes at all. And you're going to deduct all of the payroll, rent, utilities, you know, the outdoor expansion of your area, all of those, the PPE that you bought for your employees or anything like that is deductible. The employer retention credit, the result is a credit or a negative expense, which will be less of a deduction. So it's kind of like income, but instead of having, remember in our example, we had $67 of payroll tax expense. If we got a $50 employer retention credit, that would make the net payroll tax expense on our tax return $17. If you decide to do the employer retention credit, you can't use the same wages that you used with your PPP funds. So you're going to bookend it, which I'll talk about in a minute. And then you're going to amend your form 941 to claim the credit and request a refund. The employer retention credit, maybe I should have started there, but the employer retention credit is basically in 2020, for every $10,000 you paid an employee, the IRS is going to give you $5,000. For first and second quarter of 2022, if you qualify for the program, they're going to pay you up to $7,500 per quarter for first quarter of 2022, 2021, and second quarter of 2021. We don't know if it'll be extended into third quarter yet. So the reason that the IRS did this, there was a rule that said you can either take the PPP loans or you can take the employer retention credit. And this was back in March of 2020. But in December, Congress changed the rules mid-game and said, no, if you got a PPP loan in 2020, you can still get the employer retention credit. So the employer retention credit is on wages paid to like each individual person. And if you're an SCorp owner, it is unclear if your W-2 wages qualify. The IRS has just said, we don't know yet. We don't know what that means. So I can't give you any advice about that yet. If you get a guarantee payment from a partnership, those wages don't qualify. If you are a sole proprietor and you don't have employees, this credit doesn't apply to you. It's only employees that are not owners at this moment that get W-2 payroll, W-2 wages. And the retention credit, if you can get it, it's super lucrative. One of my clients, their credit is like $67,000. So it's a lot. You have to have a significant decline in revenue. So your revenue had to have fallen off by at least 50%. There's rules about when you stop taking the credit as your revenue restores itself. And then basically, if you picture the year of 2020 through first and second quarter of 2021, if you think of it as a timeline, right? So we start in January goes okay, February goes okay, things kind of go off the rails a little bit in March, and then the PPP money showed up in April, right? So the IRS says it's wages paid after March 20th of 2020. But then, so I would count wages from, let's say my PPP loan showed up April 15th. I would count wages that I paid on March 20th through April 14th, because on the 15th, then my PPP kicks in. And then the PPP goes from the 15th for 8 weeks or whatever, 24 weeks, however long. And then once my PPP stops, then I pick up my employer retention credit again and carry on through the end of the year with my retention credit. So you're just going to kind of look at the year as a timeline. You're going to take out wages paid at the start of the year before March 20th. You're gonna take out your PPP wages, and whatever you have left could be eligible for the employer retention credit. The one that's not on here is the Restaurant Revitalization Fund. That is a grant. So is the Shuttered Venue Operator grant. And both of those the accounting treatment for those is you will show them as liabilities and you will recognize them as income as you basically as you spend down the money. Because with the Restaurant Revitalization Fund, less so with the Shuttered Venue, but with the Restaurant Revitalization Fund, if you don't use the money by 2023, you have to give it back, okay? So you need to be able to track where the money went. And there's a million calculators out there. So if any of these programs apply to you, just send me an email and I'll forward you a spreadsheet that you can fill out as you go. Everyone should be tracking these as they go. Then the expenses. So the expenses for the Restaurant Revitalization Grant are still deductible. And then for the Shuttered Venue grants, all those expenses are deductible and the grant is not taxable income. So the EIDL loans, the economic injury disaster loans, those are loans and will have to be paid back. So the interest portion of that is deductible as an expense, but not the loan repayment. And the loan itself, when you got it, is not income. The $10,000 or up to $10,000 for the EIDL advance or the EIDL targeted advance also is not taxable income. So does that help everyone? Those were a lot of government acronym programs. There's been so many this year. It's pretty crazy, actually. So secretly, I think Congress hates CPAs, and that's why they did that to us.
So we have two questions not related to the COVID programs. So one was about the comparison chart. It says comparison chart should have 77 instead of 182 business income tax.
Could be. Let me, hold on. I don't remember which one it's in now. Oh, this one, yeah, yes. It's because I change the examples sometimes and then I forget to update all the math all the way through. So I apologize, but yes, that is a typo. So.
All right, and then we have a question. I run my business at home, at my home office. Can you talk more about home office expenses such as phone, internet, electricity, rent, or mortgage payment? How businesses share those expenses with my family?
Yes. So, so first, the thing that I want to make sure that you understand is if you do have a home office, there are very specific things that you have to do to make sure that it will be deductible. And the first is it has to be a separate designated space. So you using your dining room table when your family is not eating dinner does not count because it's your dining room. So you having a separate bedroom that's set up as an office, that would count. So that's the first thing, is it has to be a separate designated space. And you need to look at, I'm gonna see if I can find the best. If it's not a separate designated space, that's where you're going to get into trouble with the IRS. So it has to be exclusively and regularly the principal place of business. So if you rent an office, if you have office space but happen to have a home office as well, there's no deduction. It has to be exclusively and regularly a place where patients, clients, customers are met in the normal course of business. However, the reason that you say this about where it's met is if you offer services, You can offer virtual services, but if the place that you virtually meet your customers is usually in your home office, you're okay. It can be a separate structure, but it's not needed to be a separate structure. Your inventory, it needs to be stored there. Or if it's a daycare. So you want to look at this, like, I mean, I just went to irs.gov and Googled it, but you want to make sure that you meet the requirements first before you start calculating the deduction. And then basically what you're going to do, so let's say it's a separate bedroom in your home, and then you would, if that bedroom is 15% of your overall square footage of your home, you're allowed to deduct 15% of the expenses that you paid from your home. However, I would never pay my utilities or my mortgage or my homeowner's insurance from my business account. I wouldn't even pay 15% of them. I would pay them all from my personal account, because this is that separation that we were talking about. I would pay them all from my personal account, and then I would add those expenses onto my tax return at the end of the year if I qualified. Okay, so is that helpful? And this is kind of why I glazed over it, because like these rules are complicated and can be complicated.
She said, yes, thank you.
Good.
All right, we don't have any questions for now.
Perfect. I think I can do this. There. Sweet. Okay.
All right, so do we have any more questions from anyone? It seems like we don't. Oh, wait, let's see. Actually, there is. So what is our home office? What if our home office is in another state and we are opening a bona fide office in AZ? And they will set up a home office. Does that count as tax deduction?
So you're gonna, okay, so to clarify, you'll have two home offices, one in your original state and one in Arizona?
Yes.
Okay, so I would argue that you can't, how would you conduct businesses in both places at the same time? So like, be careful there. This is something that I think you would want to get some advice about. And remember that like these home office deductions, like they're like, sometimes you're going to bend over a dollar to pick up a penny. So like, if you qualify for the deduction, you should take it, absolutely. But make sure that you qualify for the deduction and that you're, you know, because the IRS looks at them all the time. So like the last thing you want to do is open yourself up to an audit when you're in that dark gray area. So.
Okay.
Oh, here's one in the chat. There was a question early on about somebody keeping some money in the business instead of paying it all out. So the IRS doesn't care how much cash your business has, and it doesn't care how much cash you take out as a business owner. It only cares your revenue minus your expenses. So like that's what the IRS is going to tax. So let's say that it's December 31st and Paul and I are in our dog grooming business and Donna hires us and pays us $10,000, right? To, let's just say she has a prize poodle or something. So although she's got a pit bull, so she's got a prize pit bull. And so we collect our $10,000 from Donna on December 31st of 2021, and we have no expenses. The IRS does not care, and we are going to pay income tax on $10,000. So the reason that like you want to keep an appropriate amount of cash flow in your business to be able to pay for things, for business expenses as they arise, but the IRS doesn't care revenue minus expenses. Sometimes bankers will, because if you take out more money than you put in, which is possible, I promise you, if you do things like that, then bankers will be like, ooh, I don't know, this doesn't, you know, like bankers might not like it, but the IRS, it's always revenue minus expenses for that calendar year or fiscal year. So, okay, how is how is it taxed if businesses are registered in a different state and clients are in a different state? So that one is also very complicated. I'm going to say at the start, it depends on the state. But ordinarily, if you do business in multiple states, for example, like let's say I decide that I'm going to open an accounting office in California, okay? And my business does $200,000. Revenue minus expenses is $200,000, and $50,000 of that was generated from my office in California, and 150 was generated here in Arizona. On my federal 1040 or my federal 1040 form, my SCorp, would claim all $200,000 as taxable income. It would come through on my personal return as $200,000 of federal taxable income, but then it gets divided there on my state returns. I would pay state income tax on the $150,000 that was earned in Arizona, and I would pay California income tax on the $50,000 that was earned in California. So I actually have an office in Oregon as well. So if I go to Oregon and work on a client's books in Oregon, and that client is located in Oregon, I have to pay personal income tax on that money that I earn in Oregon. And that each state is different. Okay, that's the other part that I'm going to tell you. Every state does it differently. If I have a client in Washington State, for example, there's no personal income tax in Washington State. So if I get a client in Washington and I earn $10,000 on that client because I'm in Washington visiting them, guess what? Arizona can't tax that $10,000 because I earned it in a state that doesn't have income tax. So in these times of this virtual world, if you're doing a lot of things across state lines, you should do some research with those states about at what point does it trigger you becoming taxable there. And there can be income tax, sales tax, or payroll taxes. So there's 3, and it's a huge, big, giant mess. So if you get stuck, let me know and I'll email you some resources. So.
All right, and then we did have another question about home office. So what kind of home deductions would be appropriate if I offered dog boarding in my home as part of pet sitting business?
So it would be the area, the proportionate area that you use for your like within your home. So if you have a bunch of dog runs and kennels and things in the yard, like you could argue that you know, a portion of the water bill would still count because you would have to like give the dogs water while you're outside. But then if your kennels don't have electricity or lights to them, I don't know how you would argue that your SRP or APS bill would qualify for the portion that's outside. But it's all about the proportionate use, what's business, what's personal. So you measure the square footage and then you take that portion and apply it. So in theory, like your mortgage payment does come with part of a land value. So I'm not sure I would go, like you could probably deduct a portion of your mortgage interest. I would say your homeowners, your HOA dues if you have them, the water definitely, maybe the electricity. But that would be something that you and your tax preparer would want to go through and be comfortable with.
All right. So we have another question. I have clients in Washington State. I don't have office nor employee in Washington. The income from my services for clients in Washington.
Okay, I almost got that. So
Tanya, sorry, I'll go ahead and read it. I have clients in Washington State. I don't have an office nor employees in Washington. The income from my services for clients, services for clients in Washington, will I have to pay state income tax in Arizona?
yes. So
okay.
Sorry, I couldn't resist. Okay, so the reason that I say yes is because you probably solicited them from Arizona, right? So the reason, what I was saying is if I physically go to Washington and work at an office in Washington on Washington clients, it's not taxable in Arizona, but I physically have to be there in Washington. So if you're doing work, like I was telling you about my Oregon clients, right? If I work on my Oregon clients all afternoon today, because I'm physically in Tempe right now, it's taxed as Arizona income. If I go to Portland and work for that client for like a week, then that the amount of money that I earned in that week will be taxed in Oregon on my personal return. So the rules are really strange, and it's different from state to state to state. Okay, so like the rules about when you become taxable in California, it's really easy to become taxable in California. So be careful there if you're doing business there. New Mexico, like Utah, Nevada, like all of these states that surround us have very different tax rules than us. So you want to know like when you're going to trigger, and most of them, it's something called Nexus, and I'll put it in the chat. So most of them, if you trigger what causes Nexus in California, you're going to come up with a whole list of things. What causes Nexus in Washington? There'll be another list of things. So, but if you're in Arizona and soliciting people outside of Arizona, it will be taxed here ordinarily. In some instances, like New York, it will be taxed in New York and in Arizona. So just be careful there. So.
Okay, so we don't have any open questions now, and there aren't any in the chat. I did want to mention, did you answer the question from Raymond earlier? It was in the chat. It's still up. So it was, do we take all 70K of income, or can we leave some in the company and W-2 ourselves in an S-Corp?
Yeah, so if your revenue minus expenses in an S-Corp without any officer pay is $70,000, then you should probably take like 30, 35, 40% of it, 50% of it, sorry, somewhere between 35 and 50,000 as a W-2 as wages. And then you would have a W-2 for 50 grand, and you would have a K-1 for 20 grand. So that, like, again, it's not about the cash that you take. It's about revenue minus expenses. So just keep that in mind.
Okay, so we have 2 questions. What would you say is the best way to deal with various taxing in various states when selling across states? And should we research ourselves, or is it too complicated and risky to try to do this without consultation?
So if you're selling a physical product across states, those rules are different than if you're selling a service. Okay, so that's the first thing. Then like most of the time, and then about hiring an expert, like experts can be expensive, and like I'm a small business owner, so I've been there. Like, like God forbid that you have to call a lawyer and you get charged $300 for 15 minutes, So what I would say to you is like, 1, do the research and like read it. If it makes sense to you and you're like, oh, I don't qualify for that, then you're okay. If you feel like you don't quite understand, ask other people that you trust. So ask your counselor at the SBDC, ask your tax accountant, ask your friend that's a CEO of, GE or something, like whatever. Ask other people, hey, can you read this? What do you think this says? If you can't afford to hire an expert. The rules about selling stuff and having to collect sales tax can be fairly generous. So, and especially in this digital age, there's all kinds of things that you can get that plug into your websites, into Shopify, into Etsy, all of those things where they're going to do the sales tax for you. So spend that extra money, buy that extra level of service and that plan that includes the sales tax reporting and the sales tax tracking. The sales tax rules are usually things like, and they're trying to make them uniform amongst the states, but all the states have different financial needs. For example, like in Wyoming, there's only 600,000 people that live in Wyoming. So their Department of Revenue doesn't have to collect as much money in taxes as California does, right? Because they have a smaller budget because they have less people there. So if the sales tax rules, they're trying to make them the same, but they're not there yet. So the rule of thumb generally with sales tax is you have to have 200 transactions and they have to total more than $200,000 in the last 12 months, okay? So if you're selling some kind of casual something or another on Shopify or Etsy or any of those kind of like website carts, then you probably aren't going to hit that threshold, you know, the 200 transactions, and they have to be more than $200,000. You could, absolutely. So just know what those rules are in each state, and then just reach out and ask for help. You know, like there's plenty of places you can go to see what Nexus looks like in states, and it does get confusing. So that wasn't a very helpful answer, but I would say Google it. If you feel like you understand it, then go from there. If you feel like you don't understand it, then you need to explore it more until you find out one way or the other. And you could always call the states and ask them. Just be generic. I'm thinking about doing business in Kentucky. Can you tell me what I need to know? And they'll help you. So.
Yeah, she just wanted to mention that she's selling a physical product, which is books, if that helped at all.
Yeah, so you would be subject to sales tax nexus, which there's different thresholds in every state. So it depends on who you're selling to. But Etsy, for example, like Etsy does all the sales tax for you. So then you don't have to worry about it. Just make sure that Etsy's the back end of your website, and then you're fine.
All right. So I'm new to AZ. Do we have business and occupation tax in Arizona?
You do sound like a Washington person, but no, there's no B&O tax here. There is a business, Maricopa County has a business personal property tax, but there's a threshold that you have to cross for that before you have to file. And then depending on how you're structured, there could be an annual fee from the Corporation Commission. There's licensing fees for most regulatory oversight, so the registrar of contractors. If you have a TPT or a sales tax, we call them transaction privilege taxes here in Arizona, not sales tax. But if you have a TPT license, there's an annual fee for that. Can you guys, Paula, can you think of anything else?
No, I think you covered it.
Yeah.
Yeah. Okay, I think, did we cover all the questions, Esmeralda, or do we have any more?
Yeah, we just covered them all.
Okay.
Good questions, everybody.
Yes, definitely. And let me just fix my screen here. All right, so Tanya, thank you so much for taking a very complicated topic and helping to translate it down so we can understand it for as small business owners. You either love those taxes or maybe you don't like them or you hate them, but thank you so much for sharing the information. Just very briefly, before we close out our session today, if you are not yet a client of the Small Business Development Center, it's very easy to request counseling. You will just go to our website and fill out a very simple request for counseling form. And the address is listed, the web address is listed on the slide here. Basically what happens once you fill that form out, you're assigned a lead counselor, depending on what your business is and what stage you're in. And you sit down with your counselor and you'll have a conversation about who you are as a business owner, you know, what the business is, talk about some challenge areas, both maybe short-term and long-term. And we'll kind of explore with you and see kind of where can the SBDC fill some of the gaps you have to help you move forward and achieve the business goals that you've set. And, you know, we're here, we're not just a one-stop, you know, question service, right? We're here to help you along your journey to achieving your business goals. So we have an initial session, and then we have follow-on sessions, and then we track those business goals and those metrics. I didn't mention when we first started our session today, but this no-fee counseling that we offer, this is possible because we are funded by the Small Business Administration at the federal level, by Maricopa Community Colleges locally here in Maricopa County, and then our partnership with the Arizona, the ACA, the Arizona Commerce Authority. And so it is no-fee counseling, but we're looking to help you long-term to grow that business, to see that success. So I encourage you to request counseling and sit down and talk to a lead counselor. We do have Tanya coming back in October. It's October 12th, I believe is the date, and the topic will be on payroll taxes, another really important topic. And so hopefully you'll join us for that session. July, we have several sessions coming up. Social media success, a winning guide to social media on the 13th. Nancy Hahn, one of our SBDC counselors, will be talking about buying a business. So if you're starting that process, come join us on the 15th to learn more about what you need to be aware of as you move through that process and prepare and how to get through that process successfully. We have our next Learn the Basics of Google Ads in our Grow with Google series on the 20th. And then Employee Retention Tax Credit, as Tanya was speaking to, on the 27th. We have a guest speaker coming in to talk in more detail about that particular topic. So hopefully we'll see you at a future session. And I encourage you to follow us on our social media. You can sign up for our newsletters, just so you stay in the know about what's happening at the SBDC. And we like to share with our clients what's going on as things change, as we continue to navigate through COVID. If you have any questions, please feel free to reach out to me. My email is on the slide. And again, request counseling if you need some help. Don't struggle alone. There are resources to help you. If we're not the right fit for you, we are happy to. We have many community partners in Maricopa County. If we can get you to the right resource that fits your need, we're happy to help you with that as well, and to help our small businesses. Esmeralda, do you want to close us out with any additional announcements or information?
Yes, I just wanted to let everyone know that I will be sending an email out with the information that Tanya provided today, her presentation, and I'll be sending the link to our recording of the session, and I will be letting you know about upcoming events as well. That is all that we have for today. Thank you so much for joining us, and we'll see you next time. Thank you.
Bye, thank you.